We are presenting a paper for the first time. It's co-authored with David Ling, who's at the University of Florida. It's about work from home, COVID, and online retail effects on commercial real estate prices. Since the pandemic, we've seen dramatic shifts in the direction of commercial real estate prices. Initially, across the four major property types, we've seen prices fall, but then they rose rather sharply in the United States, though to varying degrees, mainly stimulated by interest rates and the return of people to a more normal pace of life once the vaccines were available in early 2021. But then prices dramatically turned down, primarily due to a turnaround in market interest rates, particularly long-term rates, which subsequently rose, and prices have fallen from their peaks. In fact, prices have fallen nearly as much percentage-wise as they did in the great subprime bust. And by the way, all these prices are deflated by the GDP deflated for the United States. So we see the recent decline from the peak for apartments of about 34%, which was on order what we saw following the global financial crisis or the Great Recession in the United States. Office prices have fallen by nearly 40% in real terms versus 47% in the other downturn. And we've seen notable declines for warehouses. These are going to be affected by things like online retail sales and retail power centers. A retail power center is a retail conglomerate of buildings where there's one major retailer and several other stores. It is not a mall. But the other thing that we noticed is a greater divergence of prices and earnings price ratios or cap rates across different types of commercial real estate. This has been aided by a higher demand from a rise in online shopping, which has particularly boosted warehouse prices. If we look at apartment prices, we look at apartment prices, they had risen, but now they're down. But you see a great divergence here, whereas before they tended to trend together with sometimes an exception in the commercial real estate area. The other thing I should point out, did it again. The other thing I should point out is we've seen a return of some sort of retail shopping centers have only had mild declines. People are back, and I will discuss what was going on there a little bit later. Now, if we take a broader view of commercial real estate, we've actually had three commercial real estate busts since the 1980s. In the early 1990s, we had a huge decline in office prices. We had overbuilding in the 1980s, stimulated by excessive tax incentives to build buildings. We also saw something similar for apartments, though not as great. We had a bust during the global financial crisis and the Great Recession, and we've had a more recent bust occur. The nature, of course, differs. One thing about commercial real estate prices, and these are data from NCREIF. These data are a blend of actual transactions prices as well as appraised prices. And appraisal prices tend to be lagging indicators. And this is important because the actual extent of fluctuations and swings in the actual transactions prices can differ depending upon whether or not you include a good deal of appraisals in your basing of prices versus the blue line here is from Green Street. And Green Street has a more transactions-based index. And these are for commercial offices, and you see much more pronounced swings in prices. But nevertheless, whether you use Green Street or NCREIF data, you we'll see quite a bit of change. But this raises an issue that many of the price indexes that we use for commercial real estate are stale, and they may lag. You'll notice that the Green Street data tend to move ahead of the NCREIF data. And so if you think you're at a bottom with appraised prices, you may or may not be. Something to keep in mind. These busts are relevant at the national level because over 20% of bank assets are commercial real estate, and most of the originators of commercial mortgage-backed securities are commercial banks. The loan losses from those three prior real estate busts, commercial real estate busts, have been linked to credit crunches. And by the way, commercial real estate losses were just as important as subprime losses, subprime housing, subprime mortgages, residential mortgage losses were in the great housing bust in the United States from 2007 to 2011. I'll also add that it was commercial real estate problems that triggered the collapse of Bear Stearns and the collapse of Lehman. But unlike 2007, 2009, house prices are not falling with office prices. Now, at the local level, there's a lot of variation. There's the so-called donut effect that Barrero and Bloom have coined. I'm sorry, Romani and Bloom have coined, whereby people are leaving the city centers and moving to the suburbs. In fact, for I think the first time in US history, vacancy rates at the national level for suburbs are lower than they are in city centers. This is also important because commercial real estate property taxes are very important. Real estate taxes in general vary. The dependence of city revenue on real estate taxes vary a lot. These figures include residential, but there are cities like Dallas and Boston which rely a lot on overall real estate taxes. And if there's a collapse in property values, it could impinge upon municipal finances.
So one paradox is house prices not falling, whereas apartment prices are.
Right.
So that's an important distinction.
Right. And part of the reason for apartment prices declining is that there was been a tremendous amount of building that was stirred by the low interest rates of 2020 and 2021. Net supply is now hitting the markets, particularly in certain Sunbelt cities, and there's some rising vacancies there. Let me move on. So what I'm going to do today is present to you a discount model of commercial real estate valuations and essentially the pandemic effects, whether they be direct in terms of government restrictions on what people can do, or whether they've induced more online retailing or spurred the work from home revolution. These are all going to take effect on valuations through affecting expected rents and risk premia. I'm going to first show you some of the expected rent effects, and then I'm going to move to a model of risk premia, because if office buildings are much riskier, whereas warehouses that Amazon or whatever online retailer you're depending on, if there's greater demand for online retailing, there's greater demand for warehouse space, that's going to have very big effects on risk premia. We're going to test for these effects, looking at required rates of return. We'll discuss that a little bit further. And then at the end, I'm going to fold these together to try to give you an overall perspective on what the effect of work from home and online retailing are at this point in time. I mean, there are obviously limits, and I'll discuss those as we go along. So we're going to start with a discounted cash flow approach. And basically, the idea is that the equilibrium price of a building is the present value of all the cash flows. And the jargon in commercial real estate is to refer to rents, net rents, as net operating income. So think about that as profits. And you're going to discount that by a required rate of return, R. And in the limit, you get the Gordon growth model, where the equilibrium price is basically first period earnings divided by the required rate of return minus the growth rate of net operating income, which we're going to proxy for by using expected rents. This is essentially the equilibrium price. It implies that the PE ratio is 1 over R minus G. You invert that, and you have an earnings price ratio, which essentially is what they call a cap rate in the jargon of commercial real estate. So cap rate, just think about it as an earnings price ratio. Oh, I'm sorry. This is the cap rate down here. Think about the cap rate as an earnings price ratio. And I've used this, we've used this, David and I have used this before with work with Pat Hendershot. Now, let me describe to you the data, because the data series that we're using actually directly measures cap rates, required rates of return, expected rent growth. Whoever designed this survey knew what they were doing. This tax depreciation, the present value of tax depreciation benefits, is something that David and Pat Hendershot have calculated along with me. So we're going to use that from that series. But our primary series, data series, comes from, bear with me, the Real Estate Research Corporation's quarterly survey, which this survey compiles information from leading U.S. commercial real estate investors, lenders, fee appraisers, and managers who tend to operate in the what's called the tend to operate in Class A property markets, particularly the prime end of the upper end of Class A. Think about these as this survey is surveying people who are dealing with top quality properties that institutional investors like life insurance companies, they're willing to invest in the mortgages or buy the buildings outright. And these are reported separately for the 4 major property types: multifamily or apartments, central business district office, retail power centers, and industrial warehouse. Industrial warehouse includes the fulfillment centers that the online retailers use. A distinct advantage of using these data, now RERC, I should mention, has been bought out by Sitmas AMC, is that they track a notional cap rate. Some of the data, for example, the American Council of Life Insurers is a wonderful survey, but they report data on cap rates based on actual transactions. The difficulty there is the mix of property quality can vary. And so you have to control for unusual shifts sometimes in the ACLI data if you use them. But here we have a notional institutional grade, constant quality assessment of what the going cap rate is in market transactions at the moment. A second distinct advantage is these data do report assessments of these leading agents in the commercial real estate markets. They ask them for the required rate of return and the expected rental growth. With the required rate of return, then we can subtract off a benchmark rate to calculate a risk premium. And the third distinct advantage of using these data is that they're not coming from different sources. So we don't have to deal with differences in the composition of or the nature of surveys. They're all coming from the same source. And as I mentioned before, the tax depreciation write-offs are just an extension of some of the earlier work that David Ling and Pat Hendershot have done with me. Now, if we calculate a user cost as a required rate of return minus expected rental growth, and we test for co-integration between the cap rate, once again, that's the earnings price ratio and the user cost, you end up finding that the series are co-integrated. They move in this survey, they move almost instantly together. There's really no lagged adjustment here between the cap rate and the user cost. The user cost coefficients are basically nearly 1 for apartments and offices, 0.8, 0.5, 0.85 for retail and warehouse.
The speed of adjustment.
There's hardly, there really is no lagged adjustment. In fact, let me show you right here. Here's the cap rate, and here is the required rate of return minus the expected rent growth, tax adjusted. So you think, oh well, then everything is fine. The current cap rate is telling us everything. The problem is that the lagged adjustment is in the required rate of return, and we're going to get to that a little bit. So for one way of thinking about the required rate of return, it's approximately equal to a benchmark investment grade corporate bond plus an additional risk premium above and beyond that on corporate bonds. The investors in commercial real estate are investing in private assets. It turns out that the corporate AA rate is much more tightly linked to these required rates of return than is the 10-year treasury rate, for example, or the 30-year treasury rate.
And the risk premia are specific to the type of CRE.
Right.
Each type has a different risk premium.
Right. Well, what we're doing is we're modeling the required. We have data on the required rate of return. We're going to model the required rate of return.
Yeah.
And implicitly, we're going to use an explicit benchmark, and then we know the remainder is some sort of a risk premium, and we're going to proxy for this risk premium with several things. One is the capital requirements on mortgage lenders. Now, banks are the marginal lender in this market. If capital requirements are high, if there's a disaster in the commercial real estate market, they're going to be dealing with paying a lot of the first loss. So the bigger the capital requirement on banks, the more the private sector bears the loss, and the higher the risk premium are. And the business cycle should also affect the risk premium as well. And the risk premium probably also include a liquidity premium, which can vary with the business cycle. Some work with David and I, you could basically, these risk premium are well modeled by these two elements, but this was in a sample before COVID, before the pandemic.
Should the inflation rate affect the risk premium?
Well, we have a required rate of return, which is nominal.
Yeah.
And we have a nominal corporate rate here, and we have a nominal risk premium. But when we think about the cap rate is the earnings price ratio, net operating income divided by the price. So in a certain sense, that's real. You can think about the required rate of the expected rate growth tends to move with inflation. So in a certain sense, it is a real model, but sometimes these things do not move with general inflation. And so if we take the required rate of return and we subtract off the AA corporate bond rate, we don't use the AAA rate because hardly any companies are rated AAA anymore. And by the way, there's an Enron distortion. The AAA rate back here. But if we look at the required rate of return minus the AA rate, you see that the implied risk premium for these four property types tend to move together quite nicely, except they start diverging a bit here. And one of the things I should mention is if the required rate of return lags behind the market interest rate, you're going to get some wiggles in here, and we're going to come back to that a little bit later. So what we're going to do is we're going to take a pre-COVID view of the required rate of return. We're going to have a pre-COVID benchmark baseline model, sorry. I need to silence my own phone, it's rather embarrassing. And then what we're going to do is test in a full sample by adding some COVID-related variables to see if the risk premium behavior has changed. Oops. Fix that. So, how can we think about the effect of COVID-related effects? Well, let's think about the office valuations. If we have increased work from home, that will reduce the demand for working in offices and could work through lowering expected rents. And that will raise the user cost. The only way for the user cost to rise with fixed earnings is for the prices to fall. And that will cause cap rates or earnings price ratios to rise and property prices to fall. But that's not the only effect. If you view investing in commercial offices as much riskier in a post-pandemic world, in a world with work from home, especially in the United States or maybe Ireland or maybe the UK, where people do work from home a lot, you'd expect there to be an increase in the risk premium on these sorts of properties. That will raise the required rate of return. That in turn will boost the cap rate or the earnings price ratio. In a world where rents are predetermined, then property prices have to fall for the cap rate to rise or the earnings price ratio to rise. Now let's think about the opposite case. Let's think about industrial warehouses. So if there's increased online shopping, there's an increased demand for warehouses. In fact, the warehouse vacancy rates have plunged in the last several years. Rents are going up and for industrial warehouse space. That will tend to lower the cap rates and boost warehouse prices. That's not the only thing that's going. Warehouses in the old days were not considered, among the four major property types, they were not considered the prime class. Usually apartments and offices were considered to be more premier than retail and warehouse in the old days. Not anymore. In fact, in a world of increased online shopping, warehouses are now viewed as more of a safer bet than offices. We've seen lower risk premiums that will reduce the required rate of return, that will tend to lower the earnings price ratio or cap rate and boost commercial prices. So you can think of it like that. So let's take a look at rent growth and what's happened since 2019. This is a chart of expected rent growth that's surveyed from the AMC SITMUS or RERC data. And you can see that the expected rent growths of the four property types tended to move very tightly together. There are some minor differences, but since COVID, you see this widening, you see this increased divergence. And let's take a look at this in a little more detail. All of them show an initial decline from the pandemic, but then there's a recovery. And you see this particularly with retail power centers. It plunges, but then it's recovered quite a bit. And basically, people are back shopping again, at least in the United States, at least in the major top-end shopping centers. People are back. This suggests that there's a temporary effect. Much of the effect of online retailing had occurred for malls, not so much power centers. You can think about a lot of the power center establishments, the Walmarts, the Targets, the Lowe's and Home Depot. You know, they could be a center for a power center. They could be the anchor store for a retail power center. They operate. They're almost like warehouses. Shop. On the other hand, we see warehouse rents have shifted up. Apartments shifted up, but now they're back down. And part of what's going on there is we had a big decline in vacancy rates after vaccinations became available. People started moving to apartments again. And then a lot of construction came along, and a lot of those buildings are coming online. Vacancy rates are starting to rise in apartments. So you see the expected rent growth softening. And then here's the troubled child of this family. Commercial real estate, central business district office buildings, where expected rents are notably lower. They've shifted down. And let's think about this. So if we look at the change in expected rent growth, let's look at it from 2023 Q4 versus 2019. we see that it's fallen by 1.2 percentage points. This is quite dramatic. Apartments is unchanged through the wiggles. Retail power centers and warehouses have actually edged up a little bit. If we think about our cap rate formula from before, we apply 1 minus the tax depreciation rate times the user cost. The coefficient on that in those co-integration models, these are from roughly the same models. You apply that to the initial rent growth, to the change in rent growth, and you come up with an implied effect on the cap rate. Roughly 1.1 percentage points on the cap rate for offices. And they think, well, how do we put that in terms of prices? Well, the cap rate in the end of 2023 Q4 was 7.3. That implies a 15% decline. What that means is the decline in expected rents has an implied effect on equilibrium prices of about 15% on commercial offices. Now, I want to emphasize one thing. This is for central business district offices, and it is for the prime buildings. And I'll come back to the issue about broader classes of buildings later. There's not much effect on apartments. For retail power centers, there's a slight upward implied rise in prices. Equilibrium prices are the same for warehouses. But this is only the expected rent side. Now let's get to modeling the required rate of return. We go back to our Gordon growth model or discount rate approach. The cap rate or earnings price ratio is the tax adjusted gap between the required rate of return and the growth rate of dividends. You can proxy for R, required rate of return, is equaling a benchmark rate. Here we'll pick the AA rate, which seems to work best, plus an implicit or latent risk premium. Before COVID, that risk premium, David and I had a lot of success in modeling it as a function of a constant plus a coefficient times the required rate of the effective capital requirement on commercial real estate. And I'll come back to that in a second. I'll show you the data we use, plus the unemployment gap, term times the unemployment gap. And the unemployment gap is simply the unemployment rate minus the natural rate of unemployment. If you substitute the risk premium in, then you'll get a required rate of return that's a function of the AA rate, capital requirements, and the unemployment rate gap. The coefficient, if the AA rate is a good benchmark rate off which required rates of return are calculated, then the coefficient alpha 1 should be, the estimated coefficient should be unity. The coefficient on alpha 2 should be positive. The idea is that the higher the capital requirement, the more downside risk the private sector bears in case the bank gets closed. And alpha 2 should be positive. Alpha 3 should be also positive. The greater degree of slack should be associated with greater business cycle risk, risk to, let's say, earnings or not net operating income from a downturn, but it could also be picking up changes in liquidity premium. People become more risk averse during downturns. So a baseline model we can think about, we're going to be modeling the required rate of return, should be a function of these 3 variables. And let me just show you some data on them. Should put this in red. This is the required rate of return on offices. This is the required rate of return on apartments. And this is the AA corporate bond yield. And you'll notice that the upturn in market interest rates begins a little bit before these required rates of return move up. It tends to be a slight lagging relationship between these and corporate rate. We're going to come back to that a little bit later. We're going to model this. These variables are, these are I1. We're going to model this in a co-integrated framework where we have a long run. The change in the required rate of return is going to depend on lagged changes in all the elements in the long run relationship, and an error correction term, where the error correction term is simply the observed required rate of return minus the implied equilibrium. And of course, the error correction term should be negative, something between 0 and -1, where the absolute value of alpha 1 gives you the speed, the implied speed of adjustment. We also include some short-run shock variables, and I think these are kind of interesting. 3 that raise the risk premium include a dummy for the quarter following the collapse of Lehman, a dummy for the September 11th terrorist attacks, which hit New York City. By the way, New York City contains roughly 20% of all commercial office space in the United States. +1 when it hit, -1 the following quarter because of the initial shock wore off. And then something for the century date change, Y2K. There was a surge, this is more applicable to retail. There was a surge in the required rate of return fell and for retail in the quarter just before the century date change. And the reason it did was there were fears that all the online stuff would be shut down when we made the change to the century date because of some coding issues, and then -1 2 quarters later. But this is really a minor one. Let me talk about some of the bigger variables. One of them is the effective capital requirement. So think about a world where the marginal lender is a bank. Under Basel I, from 1990 up until the spring of 2004, commercial banks were required to hold 8% capital against all their CRE loans in portfolio. That was also applied to any commercial mortgage-backed securities. Then in the summer of 2004, under Basel II, if you took a commercial real estate loan and you securitized it, and then you held the commercial mortgage-backed security in portfolio, there would be a 20% risk weight, 20% times 0.8, times 8%, or 1.6. You'd only be required to hold 1.6% capital against a AA or AAA rated commercial mortgage-backed security. This was also applied to subprime and subprime residential mortgages. So essentially, the private sector is bearing the marginal lender, banks, are being required to hold much less capital. And of course, if they're holding less capital, they're willing to take more risk, and the risk premium plunges. Well, that didn't work out too well. Basel II was a complete disaster. Some of the work that I've done with John Mulbauer and Anthony Murphy tied the subprime crisis to this easing of capital requirements that fueled the subprime boom and bust. David Ling and I also described how this change induced a decline in risk premia and caused a bubble in the commercial real estate market that also burst. And Dodd-Frank is passed in the third quarter of 2010. And one of the changes made under Dodd-Frank is that from now on, any originator of a commercial mortgage-backed security has to bear the first 5% loss on that security. So if a major bank securitizes a bunch of commercial mortgages, then whomever holds it, that bank still bears the first 5% loss. So they put some skin in the game for the issuers of mortgage-backed securities, and it brings it up to 5%. And David and I have used this, and And that it seems to work pretty well. The unemployment rate gap is just simply the unemployment rate minus the natural rate of unemployment. And you can see that the unemployment rate soared during, these are quarterly, these are not monthly. So on a quarter basis, they soared about 9% at the height of the crisis, and they have obviously come back down. So once again, high amounts of slack will be correlated with higher risk premium. And if you're below zero, that will work the other way. Okay, so we only have a baseline level, and that works pretty well before COVID. And now, to deal with COVID-related effects, we can ask several things. Does the rise in work from home, WFH, raise the office premium? Does it lower the apartment risk premium? So people's, if there's higher demand for apartments, then maybe that will work from home is associated with the declining risk premium. I'm a little skeptical about this because it's harder to work out of an apartment from home. It's different if you have an owner-occupied home where you can expand more easily. We're going to measure work from home using several different measures, and let me just give you a description of where the data come from. From 2019 and before, there are two surveys that the Census Bureau of the United States conducted, asking people about, do you work from home? Typically, it was a relatively small share. The dashed line, starting in the spring of 2020, Barrero, Bloom, and Davis started to survey people about what share of time you were working from home. So here we're measuring all workers. If you're working 100% time, 100% from home, you'll say 100%. If you're working 10% from home, 10%. So this is based on what percent of hours are work from home. And of course, it soars in the spring of 2020 Q2. We had government imposed restrictions and everybody stayed at home pretty much. And then that fell back quite a bit in the third quarter, late third quarter of 2023, when those restrictions were lifted. An alternative to this raw series is a total adjusted series where what we did was, well, nobody expected, except for a few screwball paranoids, that we would be permanently at home for the rest of our existence. I don't think that any firm planned on 63% of their workers working from home for the rest of our lifetimes. So what we did was we said, well, let's just try to be fair to this overall number and set the Q2 and Q3 numbers for 2020 equal to the Q4 number. So kind of, it's a way of trying to abstract from the spike, and that gives you the black line. Then, as an alternative, we took the work from home series from the Census Bureau. So the Census Bureau asks people, what share of workers primarily work from home? And that'll be the green bar here. It's adjusted for that second quarter effect as well, but we interpolate this on a quarterly basis. We interpolate this to quarterly numbers. And the idea here is this is based on the share of workers who are working from home primarily. The reason these may differ, I think it's twofold. One is this is a little more variable if we look at it based on the share of hours. The other thing is if many people are going back to the office 3 days a week, the company still has to have an office space for you. They're typically not going to share office space with another company for all sorts of security reasons. On the other hand, the people who primarily work from home are people who may show up at the office once a week, maybe once a month. You're not necessarily going to have an office space devoted to that. So this number here, the share that primarily work from home of workers, not work hours, may be more indicative of the hit. It's an empirical issue, but we're going to test off. Second big thing is online retail. Does online retailing raise retail risk premium or lower warehouse risk premium? Let me show you the data on online shopping. I combine this with mail order share because what happens is the online share of retail sales, this is produced by the census as well, has gone up quite a bit over time. That's the black line. And part of it has come at the expense of reduced mail order. So we want to abstract from that if we're thinking about what's the net effect on warehouses, because mail order companies were used in warehouses as well. And then I constructed two trends just to raise an issue. When COVID hit, obviously the online share of retail sales soared. People were ordering stuff from home rather than going shopping, and they were buying more goods rather than services. And goods tend to be a little more amenable to buying online than services. But that has fallen back. And the question is it fallen all the way back to a pre-trend or not? I think that's an open question. So if you, let's say you calculated a cubic, you modeled the actual as a cubic trend from 2000 to 2019, and then you extended that, what that would tell you is online shopping has fallen back from its peak some, but relative to trend, it's above trend. Whereas if you you calculated a cubic from 2010 to 2019, this suggests that online has basically gone back to the earlier trend. So there's some issue about whether or not this surge in online shopping should really affect the risk premium if it was anticipated or not. Finally, and by the way, just a spoiler alert, this online retail shopping stuff does not really affect the power centers so much. But if we look at government restrictions on people's mobility, it does. So basically what we did was we have a variable called GREST for government restrictions. This is the Oxford Blavatnik Center's index of government restrictions. And that looks like this: surges, comes down, essentially becomes zero in 2023. And the Biden administration said, okay, no more COVID restrictions. And the states pretty much followed. To some extent, the government restrictions also pick up people's fears of the virus. We also look at a modification where we multiply that by 1 minus the rate at which people are fully vaccinated from the prior quarter. That's the dashed line. So the idea here is, yes, the government restrictions were in place, but they may overstate the effect on people's actual mobility. This is an empirical issue. We just try this. Now, this variable is put in the short-run part of the equation, but you can think about it as a series of short-run shocks that eventually will wear off. So what do we do to model the premium? We basically, for offices and apartments, we use Johansson's procedure. We estimate 6 long and short-run models of the risk premium, of the required rate of return. Models 1 and 2 are baseline models. These include no extra COVID variables except for maybe a few dummies for when COVID hit in 2020 Q2 and Q3. 96 to 2019 Q4, and then we extend to the end of 2023. We then add the prime measure of work from home for the baseline to the pre-COVID sample, and then the full sample to see if we could identify this effect earlier, and then possibly see if the effect is very similar in the full sample. We also try not adjusting for that funny spike in the second quarter for the full sample. And then finally, we use the raw variable for the full sample. What do we get? Well, we find unique and significant long-run relationships for the baseline models in the pre-COVID and full samples. For the work from home models, it doesn't work in the pre-COVID sample. And that's not surprising. There really isn't much movement there. And work from home only adds information in the full sample. Let me show you some of the long-run results. This is the coefficient on the AA rate in all the models. In principle, if it's a good benchmark rate, it should be close to 1, and it generally is. And if we look at the work from home models, here's the pre-pandemic sample. Here is the full sample. We don't find a unique co-integrating variable in the full sample. We find some multiple vectors. But you'll notice that the coefficient plunges. You really can't pick up a work from home effect beforehand. And that's a shame. It would be great if we did. But once again, if there isn't much movement in work from home before the pandemic, it's a new shock. So this is the best guess given our short sample. If we use the other work from home measures, we also get significance. You'll notice that the coefficient is smaller in magnitude on the raw data here, but this is based on hours. The variation is much bigger. If we look at the implied equilibrium, this is encouraging. Here we have the required rate of return. The actual variable is solid. The dashed line is the implied equilibrium, but this is from 4 quarters earlier. And so you'll notice something. The implied equilibrium is suggesting that the actual has more to go up, meaning that commercial real estate prices did not complete their declines in 2023, if this model is correct. The other thing I should point out, let's take a look at the baseline models. So these are models of the required rate of return, for offices. You'll see that the error correction term for the baseline model in the pre-pandemic sample plunges as we extend the sample. Usually that's a sign that the baseline model, this model is missing something, is omitting something that is effective. And this is just from adding 4 more years. Now let's take a look at the preferred model. I think it's model 4. Here you see the error correction speed is very nice. Well, maybe a little high, 0.56. But the problem is, once again, you don't see any, there's no error correction in the pre-pandemic sample. So basically work from home, it's really hard to identify the effects before the pandemic. But you'll also notice the model fit. This is a full sample baseline model. These are the full sample. These are the full sample. Sorry, this is that's the baseline. Here are the full sample fits. They're much better, or notably better. So what's the interpretation? The baseline model seems to be breaking down due to omitted variable bias. However, the work from home effects are so new that you can't really identify them in a pre-COVID sample. So the work from home effect essentially has been emerging, and the effect may actually evolve with time. Part of it may also be that more and more employers are requiring people to come back to work, but it seems like we're going to a world of, for many people except for managers, a 3-day in the office work week plus 2 days or 3 days working at home. Now, if we look at apartments, in the interest of time, I'm going to skip this. We don't really find a reliable effect. Essentially, let me just cut to the chase. If you estimate the baseline model for apartments in the full sample, it does pretty well. It actually outperforms the models that add work from home in the short run. And that suggests that any effects we really can't count on the effect from work from home on apartments. Let me talk a little bit about warehouses. Pardon me. Ahead. Baseline models are 1 and 2, pre-pandemic, full sample. Here we're going to add online, pre-pandemic, full sample. What do we get? Once again, we see this pattern where the co-integrating model doesn't work well pre-pandemic when you add in online retail, the COVID effect, but it does work pretty well. And full sample, if you look at the short run, the full sample model with online retail works well. Once again, I should mention the online effect. As online retailing becomes more important, as the share of online retail sales shifts to online, the risk premium falls for warehouses. And the fits are notably better. But once again, the problem is you're not getting it pre-pandemic, you're getting it only in the full sample. Here are some of the estimated effects in the preferred models, just to give you an idea of the magnitudes of the time series, the effect, the implied effect of work from home on the required rate of return for offices jumps from about 0.15 to about 0.5, 0.55, something like that. Here is the boost, here is the decline in the required rate of return implied on warehouses. Finally, for retail, we tried putting in the online retail share, it didn't really work. But what did work were the government restrictions. So once again, you see that U-turn, and this is just for one type of retailer, the power center, which is essentially shopping at a glorified warehouse. What you see is that when government restrictions are imposed, the risk premia are temporarily boosted. But one thing to keep in mind is that you have a temporary shock followed by another temporary shock, and eventually, so you get the shock, it maybe boosts the risk premium, then you error correct down from that one quarter, but you have a subsequent quarter doing the other thing. And if you add those all up, you see this hump shape effect on the risk premium, and that fits with the retail cap rate or earnings price ratio returning back to where it was before. So let's pull this all together. If you take the cap rate and calculate the extent to which the cap rate is below the equilibrium, you get these numbers. But then you also have to take into account that the required rate of return is below equilibrium. And that's below equilibrium on the order of 1.11 for offices, quite a bit for apartments. So in other words, the required rates of return that people see in deals, they really are, the deals that people are making were based on earlier calculations. And so the rise of rates implies that the required rates of return still have a ways to go up. And if you apply some of these long-run coefficients from before, you get required rates of return implications for the cap rate. This suggests that the cap rate, and if you add these two together, you get the total extent to which the cap rate is below equilibrium. Nearly a percentage point for offices, 1.3 percentage points for apartments. That's a warning sign. And so we pull it all together. And just from the risk premium, oops, sorry, different type of clicker. Just from the risk premium, you get some degrees of overvaluation. Now, if you take into account the rent effects on prices, add the effects on the risk rate, the risk, the cap rate being in line or not in line with the risk premium or rates of return. You add them together. And basically, what we're getting here. Now, this is not about an overvaluation. This, let me back up a second. I'm sorry, I misspoke. This is the extent to which prices may be overvalued at the end of 2023. But some of that are overvaluations due to change in the interest rate environment. This abstracts the interest rate effects. So this is the effect of work from home on offices. That'll be the rent effect is to knock prices down by 15%. And the risk premium effect is to knock them down by a further 4%. The total hit is 19% from work from home on prime offices. For retail power centers, the effect is pretty much nothing. But for warehouses, we have a 6% boost from a change in expected rents. And here we're assuming that all of the change in expected rents, and this is an assumption, is due to these COVID-related effects. That may not be quite right, but if you add in the risk premium or required rate of return effects, you get another 10% boost. So basically, work from home is knocked down prime office prices by around 19% in equilibrium, but online retailing has boosted warehouse prices by 16%. Now, I should point out, so one way of thinking about all this is that commercial real estate prices are adjusting to cyclical, think about interest rate effects, as well as secular developments. There's a mix in both of these. All this stuff is going on. A shift in the interest rate cycle has raised cap rates and lowered CRE prices. That is in there. Okay. We try to isolate these longer term or secular effects. There are emerging signs that work from home has battered office prices and boosted vacancy rates. But the caveat is the evidence that we're getting, it's only since COVID that those effects are in there. We have to take that with a grain of salt. If we look at the rise of online shopping and its effects on warehouse prices, similar pattern. We really can't identify it pre-pandemic. For retail, it seems like the temporary effects on mobility were the key. There are signs that much, but not all, of the adjustment to what's going on is behind us. There is a lot of uncertainty. A lot depends on what's going to happen with interest rates, and that depends a lot on what's going to happen with inflation. One caveat I should mention in all of this, these estimates are for prime properties. There's a famous office apocalypse paper by Stein and one of his co-authors, and they estimate something very similar to what we thought, that prime New York City office building prices should be hurt by 20% from work from home. We come up with 19. We use different methodology, different data, somewhat general similar price approach. But one caveat in all of this is we're looking at the very prime. There's a lot of commentators are saying that Class B and Class C office prices have fallen even more. And some of the work that Stein has done indicates that the hit from work from home to commercial office space, it may be 20% for the prime category, but is more on the order of 45% across all property types. All property classes of commercial office. And so, and other commentators are saying that Class B properties, Class B office prices may be hurt by as much as 40% by work from home. And we may be seeing a 60% decline for Class C. Those are a little more speculative, probably based a little bit on less thick data, shall we say. And one last thing I should mention, the rise of artificial intelligence. Rising use of that could affect the demand for office workers. And that also affects, how we may, where we may need to live and work. We are obviously experiencing some long-run effects from COVID in terms of how we work and live. They are having ramifications. And let me see if there are any questions online. And I don't know if Jonathan or Janine or anyone else has any questions. But if you do, you can unmute and fire away.
I've got a question about owned occupation.
Sure.
You can think of owned occupation for residential, but also for business. So if Amazon, for example, builds its own warehouses, owns them, doesn't go to the commercial real estate market to transact, there could be quite a lot of off-market stuff that affects the total demand for warehouse. And similarly for, I think, of apartments, the commercial real estate companies that are finding a problem in the apartment sector, presumably some of them have the option of selling individual apartments to owner occupiers. So that could also affect the question of whether apartments are going to correct, whether the price correction in apartments is going to be as big as what you're suggesting it might be.
Right. Yeah, we are seeing signs of a serious pullback in apartment construction.
Yeah.
And I think you have a point there with Amazon building its own centers. I think that there's a lot to be said for that, but it's still, if they are substituting away from rented space to their own centers, which I think they're probably doing, that adds some complications. For offices, most companies don't own their own offices.
Yeah.
And those, I think in general, the mean or average lease is about 7.4 years, according to Stein and Company. Maybe about 8.25% years in New York City. So maybe the office effects are better measured because of this issue of own versus rent.
Yeah.
And it's going to be, we're going to have this situation where we're going to have a lot of dead space in many cities. We are seeing this in many downtowns.
Mhm.
We have gone from the superstar cities to the super vacant cities. And we have seen the rise of suburban office markets. People do not want to commute. And as Nick Bloom, Steve Davis, and Barrera like to say, work from home is, to a large extent, is with us. I think for many people, they got a taste of what it is like to work as a professor, and they like it. I like it too. But thank you all for your comments and questions. And if anybody who sees this recording has some suggestions, please feel free to email me. Once again, this is the first time we've presented the paper. It is obviously a work in progress, as is what's going on with work from home. Thank you.